You're experiencing a ton of growth in your new business. That's awesome. Except, could you possibly be growing broke? Let's discuss this very misunderstood phenomenon among rapidly growing businesses today on the show. We'll see you inside. Hey everyone, it's nice to see you. This channel is designed for you, the business owner, in mind, and that's what we are all about here. So you're in business and it's growing like crazy. In fact, you can barely keep up and you have more demand coming in. Isn't that great? Well, not necessarily. If you're in business for yourself and maybe you have some employees working for you, you have to watch that growth doesn't metastasize into something else. That's something else that I'm talking about is what I call growing broke. Let's unpack what that actually means. To do that, we're going to have to dig into the financial statements a little bit. It's okay, I promise. I'll hold your hand if you want. It won't be weird. All right, it'll be a little weird. So here we are with your financial statements. You have a balance sheet and you have an income statement. Let's do a really quick rundown as to what these two statements are before we go any further. Your balance sheet is a representation of your company's financial health at a specific moment in time. The balance sheet is broken up into three parts, which are the assets, the liabilities, and the equity. Let's go through this really fast. Your assets are what you own. Your liabilities are what you owe to others, and your equity is conceptually what the company would be worth if you sold all of your assets and paid off all of your debts and liabilities. Keep in mind, all of the numbers that represent your assets and liabilities on your balance sheet are the balances in each category. So if you had $30,000 of cash in your checking account at the end of October, that $30,000 would show up as cash on the assets section of your balance sheet, printed on October 31st. Keep that in mind because that's going to be important coming up. So that's the balance sheet, which again is your assets, your liabilities, and your equity. Let's take a quick look at the other financial statement, which is your income statement. Your income statement is also made up of three parts: your revenues, your expenses, and the difference between those are known as your net, either net profit if your revenues exceed your expenses, or a net loss if your revenues are less than your expenses. The other difference between the two financial statements that I talked about is the income statement, again, income statement and balance sheet, is that the income statement looks over a period of time, say 1 month or 1 quarter or 1 year. Whereas the balance sheet, again, takes a picture of one specific point in time, say like the end of the month or the end of the week. So those are the basics. To understand how a company can grow broke, it's important to understand the interrelationship between the balance sheet and the income statement, and that's what we're going to go through right now. So let's say that you're in business and you sell a product. Let's say it's gigantic piñatas, and they sell for $10,000 a piece, and you have startup capital of $35,000. The name of this business, want to take a guess? A lot of piñata. Right, you're getting bad jokes and good advice, so give me a break. All right, so let's take a look at what your financial statements would look like with your first day on the business being September 1st. So on September 1st, your balance sheet would look like this. You have in your asset section cash in the amount of $35,000. That's what's in your checking account. At this point, you don't have any other assets. You don't have any inventory or anything else. So the total amount of assets on your balance sheet is $35,000. You don't have any debt at this point, so your liabilities are zero. Your equity value, remember, is your assets minus your liabilities. So at this point, your equity value would be $35,000. So here you are, you're in the business of selling giant piñatas. And during the month of September, you sell 2 units for $10,000 each. $10,000 for a piñata. That's right, that's a lot of piñata. Now let's look at your income statement. I laugh at my own jokes. Remember, the income statement covers a period of time, where the balance sheet only covers a snapshot in time. So let's say during the period of the month of September, from September 1st to the September 30th, you have 2 sales for $10,000 piñatas. Great job. So your revenues for that period of time would be $20,000, $10,000 times 2. It costs $7,500 per unit to have this piñata made, right? Which covers all the cardboard, the colored paper, and the glitter glue, or however you make piñatas. So the total expenses for those 2 items is $15,000, $7,500 times 2. So you've got $20,000 in revenues minus $15,000 in expenses, leaves you a net profit on your income statement of $5,000 at the end of the month. All right, now let's pull over and park here for just a second to make sure you understand all of the assumptions that we're making. This is all going to assume that you're going to be able to sell, construct, deliver, and get payment on these piñatas all in the same month. In practical terms, that doesn't always happen, especially not in real life. But with that assumption in mind, this is what your balance sheet is going to look like at the end of the month on September the 30th. Remember, your starting cash balance on September 1st is $35,000. You have to use $15,000 for your expenses, which brought your balance temporarily down to $20,000 in your checking account. Then you collect on the $20,000 in sales that you made, right? $20,000 in cash plus the $20,000 in sales revenue equals your new cash balance at the end of September of $40,000. Now, I want to point something out here. If you look at your net profit of $5,000 on your income statement from September 1st to September 30th, you're going to notice that the entire amount goes to your starting cash balance of $35,000. This is what gives you the end of the month balance on your balance sheet of $40,000, right? $5,000 in profit plus your starting cash balance. Remember that we're making some very basic assumptions, that you're able to deliver the product and collect the money all in the same month. What we're talking about here is what's called the cash conversion cycle, meaning how fast do you turn over your cash into more cash. In this case, the cash conversion cycle is 30 days. Okay, so now that you understand a little better of the interrelationship between the balance sheet and the income statement, let's look at what happens to a company when you grow too quickly. This is the beginning of what I call growing broke. All right, so that's month one in business for our $10,000 piñatas. Life is good in the piñata business, and we get an order for 5 more piñatas in October. So let's go back to the balance sheet. It's October 1st, and we take our number directly from September 30th, and nothing's changed overnight, so we're just moving those numbers from the end of September, and we have $40,000 in cash. Still no liabilities, and equity of $40,000. In the month of October, from October 1st to October 31st, we had sales of 5 giant piñatas of $10,000 each. Remember, each one costs $7,500 to create. So that puts our sales at $50,000, again, 5 piñatas at $10,000 each, and our expenses at $37,500. Again, 5 piñatas at $7,500 each to fabricate, leaving a net profit of $12,500. So, what does that do to the balance sheet at the end of the month of October? On October 31st, we'd look at our balance sheet and see that you had your $40,000 starting balance for the month, right? You paid $37,500 of expenses, which left you $2,500 in cash in your checking account. Then you add in your sales revenues of $50,000, and we have, lo and behold, an ending cash balance in your checking account of $52,500. If you take the starting balance of the month of $40,000 plus the net profit of $12,500, you're also going to get the $52,500. So either way you look at it, you still get the same number. So we've had massive sales growth, right? Going from $20,000 in sales to $50,000 in sales is a 150% increase in sales in a very short period of time. You went into that second month with only $40,000, which represented a 14.2% increase in cash from the previous month. The problem here is your sales growth is happening at a rate much faster than your ability to generate cash, which you're going to see in the next example. So let's say that we have another great sales month coming up. It's November 1st, and you're sitting on $52,500 in cash assets. That's what's in your checking account. Again, no liabilities, and therefore $52,500 in equity on your balance sheet. You have orders for 8 more $10,000 piñatas at a lot of piñata. So here's what your income statement would look like for the month of November. From November 1st to November 30th, you have 8 more units of $10,000 apiece, which yields $80,000 in sales. That's great. Your expenses, again, are $7,500 per unit, and they are $60,000, which would leave you a net profit of $20,000. So let's go to the balance sheet on November 30th and see what happened. Let's look at the money, how the money would have flowed in and flowed out. You start out the month okay with $52,500 in cash, but you had $60,000 of expenses to pay for raw materials. Uh-oh. We are now in the hole $7,500. You don't have the money to fulfill 8 units, and this is exactly what it looks like when you start growing broke. You have the sales growth through the roof, but you've outgrown your ability to generate cash fast enough to keep up with that growth. Does that make sense? I'm going to say that one more time. You have sales growth that's through the roof, but you've outgrown your ability to generate cash fast enough to keep up with that growth. So let's face it, what happens in most businesses is they try to put these expenses on the most expensive kind of debt, which is credit cards. And it's not only expensive in interest, but it's also expensive in loan constant, meaning the amount of payment that you have to make for dollar in terms of how you have to service that debt. And once you start down that path, there's a lot more ways that this goes wrong than goes right. One of the things that I love about Southwest Airlines as a case study is that they've managed their growth in the good times and in the bad times. At one point in Southwest Airlines' boom period, they had over 100 different cities that were vying for Southwest to open a terminal at their airports. Do you know how many they opened that year? 4. This is because the management at Southwest Airlines knew how to manage their growth. They managed their growth during the good times and maintained an ample amount of cash so they never got over their skis. I'm going to do 2 more quick examples of what this looks like from our fake company, A Lotta Piñata. So let's get back to October. Instead of taking 5 orders of $10,000 piñatas, let's say that you only obligated yourself to 3 orders. So instead of 150% sales growth, you had 50% sales growth. Still not too shabby. So you start out the month with $40,000 in cash on your balance sheet, and for the end of the month, for the month of October rather, you starting October 1st to October 31st, you had revenues over that period of $30,000 and expenses of $22,500, which left you a net profit of $7,500. Looking at the balance sheet, let's see how the money flowed in and out of the cash balance. On October 31st, we look at your cash balance of $40,000, less the expenses of $22,500, which left you $17,500. We add in the revenues of $30,000 in sales, and you're left with $47,500 in your checking account at the end of the month. Let's look at November, with sales of 5 units. At $50,000, again, it's 5 units times $10,000, and expenses of $37,500. You have a net profit of $12,500. Your balance sheet at the end of November would look like this. Starting cash balance on your balance sheet of $47,500. That's what's in your checking account, minus expenses of $37,500, which will leave you $10,000. You add in the $50,000 in sales, and that leaves you at the end of November with $60,000 in cash. This is what smart business owners do. They hold cash so they can take advantage of the good luck events when they happen, and so they can weather bad luck events when they happen. All right. I know this has been a lot of math, but it's pretty simple math. That's not so hard, right? This is the kind of stuff I work with business owners with all the time. And it's a lot of times they're not even sure what they're looking at. And that's okay. Out of the 4 core business functions, again, we got lead gen, sales, operations, and accounting. You simply can't be good at all of them. And that's all right. Look, if you're needing some help with putting together a strategy to help you manage your growth, or if you're feeling like no matter what you do, your cash just doesn't seem to stick around, let's talk. Head over to markdolfini.com. I'll put a link in the show notes and you can get a free strategy session booked. I will offer those free strategy sessions as long as I'm able to. All right, that's all I have, everybody. Hope that you found this helpful. Please like and subscribe. And if you thought this was helpful, please let me know what you thought in the comment section. I'd like to know what you thought was helpful in this. And if you've got some struggles, let me know. I'll be happy to help you any way I can. All right, everybody, have a great day, and I'll see you next time.